I've been following a lot of people in the past several years, like Tony Robbins and all these wealth gurus and all this stuff. And then they're like saying a lot of real estate investors and real estate experts and investment advisors, and I have like mixed views on mutual funds.
Yeah.
Some people think all mutual funds are the worst. Like, oh, I never, like the super wealthy never invest in mutual funds. But some people are like, no, it's pretty good. What are your thoughts?
I think there's a time and place for mutual funds. I mean, that's why they exist. It depends on the situation, right? If you're...
Oh, why don't you start off, what is a mutual fund?
A mutual fund basically is a pie, or the easiest way to explain is a pie. Within the pie, there's a lot of different things that you can invest in there, right? So in this pool, you can have Amazon, you can invest into a TD bank, you can invest into Starbucks.
So they're just a bunch of stocks?
It could be stocks, it could be bonds. In this pie, it could be anything.
Oh, really? Okay.
Right? It could be government bonds, corporate bonds, it could be anything.
Okay.
Right? So the reason why you would invest into a mutual fund is because you want diversification. Right? So by putting $100 into this pie, your $100 is actually split up into all these things that I just mentioned. That's why you would buy mutual funds, because there's diversification. The flip side of it is, for someone else to invest into all these things for you, there is a management fee that you have to pay. Industry, on average is about 1.8 to 2%.
Oh, okay. Per
year.
Okay, so if I invest $100,000 in this mutual fund, then I get charged 2% per year?
It gets charged, but not directly deducted from the 100,000. Like, for example, if the mutual fund itself earned 10%, they'll take the 2% and you get 8.
I see. Okay, so only if I make money.
Oh, actually, both sides.
So like if my 100,000 turns to 90,000, then what happens?
So in that scenario, it's minus 10%. So if the mutual fund went down 10%, then that negative 10% actually includes the 2% that they charged. So really your portfolio went down 8, but if you include the 2% fee, it's negative 10. Yeah.
Okay, so they charge the fee regardless if you win or lose money.
Yes.
Once a year, I guess. Not monthly, right?
Well, they charge it throughout the calendar year.
Oh, multiple times?
It could be multiple times, once a month, quarterly. I mean, different funds, they're different structures.
Oh, okay.
But it could be once a year, just depending on the fund itself, right?
So these are the quote-unquote dangers of investing in a mutual fund.
Yeah, and plus it's also, because you don't see it.
Oh, like so the secrets that your mutual fund advisor will not tell you, kind of thing.
Well, they'll tell you there's a fee. Okay. They don't really tell you where the fee is coming from.
You have to read it in the small print, which is like a big telephone book, right?
Or very small fine print that you have to kind of use magnifying glass to read.
Okay. But is that in all cases, or is it like, are there mutual funds where it's like pretty darn clear, hey, here's the fee, or is it always like hidden?
The fee is on the fact sheet. You'll see a 2% or 1% or 1.5% or 3%, right? But again, they'll tell you what the fee is. But what I see, a lot of advisors, they don't go into details about how the fee is charged, right? Because going back to your example, you invest 100,000, and they're not taking out that 2% directly out of your pocket. They deduct it from your returns. So you don't really feel the real impact of losing $2,000 in fees.